Welcome to Inside Corporate Finance, the podcast where we break down the frameworks and strategies behind the global financial system. Today, we are diving into one of the most important books in the field of risk management and Financial Institutions by John C. Hull. This book is essential reading for anyone who wants to understand how modern financial institutions identify, measure, and manage risk across credit, market, liquidity, and operations. We'll walk through its core sections, from the foundations of risk and return, hedging with derivatives, and VaR modeling, all the way to credit risk, regulatory frameworks like Basel III, and concepts like RAROC and economic capital. Whether you're a risk analyst, treasurer, finance student, or CFO, the ideas in this book are practical, technical, and deeply relevant. And if you find value in this episode, make sure to subscribe to the channel, give it a thumbs up, and share it with your network, especially those working in treasury, banking, or capital markets. Let's get started.
All right, get ready to dive in, folks. We've been given quite the hefty stack of John C. Hull's risk management and financial institutions. And this stuff, let me tell you, it's anything but dull.
Well, it's really fascinating how Hull goes into all these intricate mechanisms that sort of drive financial markets, from like the psychology of traders all the way to the mathematical models that they use to assess risk.
Yeah, and trust me, by the time we're done with this deep dive, you're going to walk away with some serious aha moments. Like, for example, did you know that sometimes it can actually be better for a borrower to have no credit rating at all? Yeah, we'll get into that later. But for now, we're going to break down the key players in this whole world of risk management, the types of risks that they face, and how they try to manage them.
You might even find yourself looking at risk differently in your own life, like whether it's investing your savings or even making big decisions.
Okay, so let's kick things off with something pretty fundamental: risk and return. Seems like a pretty basic concept in finance, right?
Yeah, absolutely. It's really the cornerstone of investing. The higher the potential return, the higher the risk you're going to have to take on. But here's the thing. We're talking about expected return, which is an average over time, not a guaranteed outcome.
So it's not like putting your money in a savings account where you know exactly what interest you're getting.
Right. Imagine investing let's say, $100,000 in a stock. Hull uses this example in the book. Now, there's a chance you could earn a fantastic 50% return, but there's also a chance you could lose money. It all boils down to probabilities and, how much risk you're comfortable with.
So that's where diversification comes in, right? Spreading your investments around to reduce the overall risk.
Exactly. Don't put all your eggs in one basket, right? By diversifying your portfolio across different asset classes, stocks, bonds, real estate, you name it, you can potentially smooth out those returns and lessen the impact if any one investment goes south.
Makes sense. So we've got risk and return. Now, who are the big players in this game? Who are we talking about here?
We're talking about financial institutions. Think banks, insurance companies, pension funds, mutual funds, hedge funds. They all have different roles and different levels of, risk appetite.
But banks, it seems like they're kind of the biggest players, right? They're at the heart of it all.
No doubt. Banks act as these intermediaries. They channel funds between savers and borrowers. What's interesting is how their structure has changed over time. Hull points out that the U.S. banking landscape was much less concentrated back in 1984 compared to 2014.
So fewer banks, but they're bigger.
Exactly. We've seen this decline in the number of smaller banks and a rise in the assets held by the largest institutions. This consolidation, though, has definitely raised some concerns about systemic risk. The risk that if one large institution fails, it could trigger, a domino effect throughout the entire financial system.
Yeah, and that brings us to, the elephant in the room, the 2007 credit crisis. That had a massive impact on banks and how they manage risk, didn't it?
Absolutely. It really exposed some vulnerabilities in how banks were assessing and managing risk, especially when it came to those complex mortgage-backed securities. The crisis ultimately led to the Dodd-Frank Act here in the U.S. It's a sweeping reform aimed at preventing another meltdown.
Okay, Dodd-Frank, that definitely rings a bell. But can you remind me what it actually does? It's like one of those things I know I should know, but...
Think of it as this huge rule book for the financial industry. One key piece is the Volcker Rule, which restricts banks from engaging in proprietary trading, that is, making risky bets with their own money. It's supposed to prevent them from taking on too much risk.
But hasn't there been some pushback on the Volcker Rule? I vaguely remember something about it being too complex and maybe even hurting market liquidity.
You're right. The Volcker Rule has been pretty controversial. Some critics argue that it's hard to implement and might have some unintended consequences. It's a complex issue, no easy answers. But it does show how regulators are trying to, walk this tightrope of limiting risk-taking by financial institutions without, stifling innovation or economic growth.
It's a delicate balancing act, for sure. So we've talked about risk and the big players. Let's dive into the different types of risk that financial institutions face. I know this can get a bit technical, but it's essential to understand what we're dealing with here.
Yeah, absolutely. Hall breaks down the main categories as market risk, credit risk, operational risk, and liquidity risk. You could say they're the four horsemen of financial risk, so to speak.
Okay, let's tackle them one by one. Starting with market risk. This is all about how changes in market variables like interest rates, exchange rates, stock prices, that kind of thing can impact a portfolio's value, right?
Precisely. It's the risk that your investments could lose value due to factors that are completely outside of your control.
So like if interest rates go up suddenly, the value of my bonds could plummet.
Exactly. And if you're a company doing business internationally, those fluctuations in exchange rates can have a big impact on your profits.
Hull talks about the LIBOR-IS spread as a kind of indicator of market risk. Can you break that down for me? What does it tell us, and how does it connect to, banks' willingness to lend money?
LIBOR, that's the London Interbank Offered Rate. It's a benchmark interest rate that banks use to lend to each other. OIS stands for Overnight Index Swap, which is another interest rate benchmark. The spread between these two rates reflects how banks see the risk in that interbank lending market. A wider spread means banks are more hesitant to lend to each other, which can be a sign of, increased risk aversion or even potential instability in the entire financial system.
So it's kind of like a canary in a coal mine for the banking sector. If that spread starts to widen significantly, it's a warning sign that something might be wrong.
You got it. Definitely an indicator worth watching closely.
Okay, on to the next risk, credit risk. This is all about the risk of borrowers defaulting on their loans, right? Not paying back what they owe.
That's it. It's the risk that a lender won't get their money back. This is especially relevant for banks because, lending is such a core part of what they do.
So how do they assess credit risk? Is it just a gut feeling, or is there more to it?
It's definitely not just a gut feeling. It's a very rigorous process of analyzing a borrower's creditworthiness. They look at factors like their financial history, their income, assets, debt levels. They even consider things like the broader economic environment and what industry the borrower is in.
So I guess it's kind of like a detective investigating a case, looking for clues to determine if a borrower is likely to repay their debts.
That's a great analogy. And then to make things even more interesting, we have rating agencies like Moody's and Standard & Poor's. They actually assign credit ratings to borrowers. And these ratings can influence how investors perceive the risk.
So a AAA rating, that's like getting a gold star, right? It indicates there's a low risk of default. But we know those ratings aren't always foolproof. I mean, the 2007 crisis showed us that those complex mortgage-backed securities with those high ratings were actually way riskier than people thought.
Absolutely. That crisis really highlighted the limitations of relying only on credit ratings. It exposed the dangers of securitization. That's where you bundle up loans and sell them off as investments, which can sometimes obscure the real risks of those underlying loans.
Makes you wonder if we've truly learned our lesson from that crisis. Okay, let's move on to operational risk. This one seems a bit broader. What exactly falls under this category?
Operational risk is kind of a catch-all term for anything that could disrupt a financial institution's operations. It includes things like internal fraud, system failures, data breaches, natural disasters, even regulatory changes.
So it's not just about financial risks, but also risks that come with running a complex business, right, with all its moving parts.
Exactly. And one of the tricky things about operational risk is that it's really hard to quantify. Unlike market risk, which you can sort of model and measure using historical data, operational risk often involves these rare events that haven't happened before. So it's tough to predict and prepare for.
So it's about building in safeguards and redundancies, right, to try to mitigate the impact of those unforeseen events.
Right. Things like strong internal controls, really robust cybersecurity measures, business continuity plans. It's about creating a resilient organization that can withstand unexpected shocks.
All right, and last but not least, we have liquidity risk. This is all about being able to meet your financial obligations as they come due, correct?
You got it. Imagine you're a bank, and suddenly all your depositors want to withdraw their money all at once. If you don't have enough liquid assets on hand, you could be facing a liquidity crisis.
Yikes, that sounds like a nightmare scenario. So what are the different types of liquidity risk? How do they differ?
Hull makes a distinction between what he calls liquidity trading risk and liquidity funding risk. Liquidity trading risk is the risk that you can't unwind a position quickly without taking a big loss.
So, like, if I need to sell a large position in a hurry, I might have to accept a lower price, which would eat into my profits.
Exactly. And it gets even more complicated if you're trying to sell a large position in an asset that's not very actively traded. You might not even be able to find buyers, which could push the price down even further.
And liquidity funding risk, that's more about making sure you have enough cash on hand to meet your obligations, like making payroll or paying your suppliers.
Right. It's the risk of not being able to raise funds when you need them, even if you have assets you could sell.
Okay, let's say I'm a trader and I need to unload 100 million units of an asset, let's say, over 5 days. How do I manage that liquidity trading risk? What's the best strategy?
Well, now things are getting interesting. You need to be very strategic about how you unwind that position. You have to think about things like the trading volume and the bid-offer spread, which usually widens as trading volume goes up. It's a balancing act between needing to sell quickly, but also minimizing your trading costs.
So it's not just about selling as quickly as possible, but about being smart about it, right?
Absolutely. You got to find that sweet spot to avoid a fire sale that could tank the price.
All right, we've covered what we called the 4 horsemen of financial risk. But there's another risk hiding in the shadows that's just as dangerous: model risk. Now, this is where things get really interesting.
Model risk is so fascinating because it really exposes the limits of relying only on mathematical models in a world that's always changing.
So models are supposed to help us assess and manage risk, but they can also create risk themselves. That seems kind of counterintuitive.
Exactly. Models are, at their core, simplifications of reality. They make assumptions, and sometimes those assumptions don't hold up, especially when you get into these extreme situations or things that have never happened before.
It's like trying to navigate a maze with a map that's missing half the paths, right? You might think you're going the right way, but then suddenly you hit a dead end.
That's a perfect analogy. And this is especially true when you're trying to price really complex financial instruments, especially when you don't have observable market prices to use as a guide.
So what are some concrete examples of how model risks can actually play out in the real world?
Let's look at options pricing, for instance. Traders often use models that are calibrated with something called implied volatility, which is basically the market's expectation of how volatile things will be in the future.
Okay, so far so good.
Now, here's the interesting part. This implied volatility often forms a pattern known as the volatility smile, or sometimes the volatility skew. What it means is that the market assigns different levels of implied volatility to options with different strike prices.
And with stocks, we usually see a skew, right? Where out-of-the-money put options, the ones that would pay off if the market crashes, have those higher implied volatilities.
You got it. And here's what's really fascinating. This skew wasn't as pronounced before the stock market crash of 1987.
So is that because the crash changed how investors thought about risk? Did it teach them a harsh lesson about how quickly things can go wrong, the sudden market downturns?
That's a great question, and it's something that researchers have been looking at for decades. The 1987 crash was like this wake-up call. It highlighted how limited those traditional risk models were, and the importance of thinking about what we call tail risks, those low-probability, high-impact events that can be just devastating.
It's like the market developed a case of crashophobia. But instead of just freezing up, traders started pricing that fear into the market. They demanded higher premiums for options that would protect them if another crash happened.
Exactly. It shows how much market psychology influences risk assessment and how historical events can shape how investors see risk, sometimes for years to come.
So it's not just about the numbers. It's about the human element, too, the emotions, the biases that drive how markets behave.
Absolutely. And that leads us to the next big question. How do financial institutions manage all of these risks? What are the tools and techniques they have at their disposal?
Let's dive into that world of risk management then. We've got a lot to cover, from hedging with derivatives to stress testing to this concept of economic capital. Get ready for some serious insight into the strategies these institutions use to navigate this complex landscape. Okay, so we've basically laid out the battlefield, identified the main players, and we've seen the kinds of risks they face. But how do these financial institutions actually manage all this risk? It feels like a never-ending game of whack-a-mole, new risks popping up all the time.
Yeah, you're not wrong. It's definitely a dynamic field, always changing. But the good news is there are all sorts of tools and techniques that institutions can use to try to mitigate risk.
So let's break down these defenses. Where do we even start?
Well, let's begin with market risk. A common strategy is hedging using derivatives. Think of it like buying an insurance policy, to protect yourself against those adverse market moves.
So if I'm worried about interest rates going up, I could use a derivative to lock in a fixed rate and reduce my exposure to that risk.
Exactly. You're basically trying to offset those potential losses in one area with gains somewhere else. It's a way to, manage your overall exposure to that volatility.
But derivatives, they can be pretty complex, can't they? Weren't they part of what got us into trouble during that whole financial crisis?
You're right. They can be pretty complex, and they were definitely misused back then. But when used correctly, they can be powerful tools for managing risk. It's all about understanding how they work and using them strategically.
So it's not a cure-all. You need expertise. You need to be careful.
Yeah, absolutely. Another important tool for managing market risk is something called value at risk, or VAR. It's a statistical measure that estimates the potential loss a portfolio could face over a specific period with a certain confidence level.
So it's like putting a number on that risk, giving me something concrete to work with.
Exactly. And there are different ways to calculate VAR. Each one has its strengths and weaknesses. Some methods use historical data. Others use more, complex simulations to try to model potential market movements.
I've heard of Monte Carlo simulations. Is that one of the methods used for VAR?
It is. Monte Carlo simulations use random sampling to generate thousands of possible scenarios, which helps you get a more comprehensive picture of those potential losses.
But even with all those fancy models, there's always a chance that something completely unexpected could happen, right? Something the model just didn't see coming.
That's true. That's where stress testing comes in. Instead of just looking at historical data and probabilities, stress testing tries to answer that what-if question, like, what if something really crazy happens?
So it's about prepping for those worst-case scenarios, those black swan events that nobody sees coming.
Exactly. Like, what if interest rates spike suddenly? What if a major currency collapses? What if we have another global pandemic that shuts down the whole world economy? Stress testing makes you think outside the box. Consider those tail risks that your traditional models might miss.
It sounds like a vital part of risk management, especially with how unpredictable things are these days.
Absolutely. Now let's shift gears a bit and talk about credit risk. How do institutions manage the risk of borrowers defaulting on those loans?
Well, I'd imagine it all starts with doing your homework, right? Really vetting those borrowers before you give them any money.
You got it. Credit analysis is crucial. You dig deep into the borrower's financial history, their income, what assets they have, their debt levels. It's all about getting a really clear picture of their financial health and whether they can actually repay that loan.
But even with the most thorough analysis, there's always a chance of something unexpected happening, right? Like someone loses their job or they have a medical emergency, something like that.
That's true. That's why lenders often require collateral for those loans. If the borrower can't pay, the lender can take that collateral to try to make up for their losses.
Makes sense. Like a safety net for the lender.
Exactly.
Yeah.
And along with collateral, lenders use things like credit scoring and credit limits to manage their exposure to each individual borrower. They might also diversify their loan portfolio across different industries and geographic areas to spread out that risk.
So again, it's about not putting all your eggs in one basket, just like with diversifying your investments.
You got it. And then you have credit derivatives, things like credit default swaps. These allow lenders to actually transfer some of that credit risk to someone else. It's another way to hedge against those potential losses.
It's all about managing that exposure, finding ways to minimize that potential downside, however you can.
Precisely. Now, operational risk. How do you even begin to prepare for the unexpected, for those events you can't really predict or model?
Well, I guess it involves having really strong internal controls, right? Making sure everything's running smoothly, that there are checks and balances to prevent any errors or fraud.
You're absolutely right. Internal controls are super important. It's about having clear procedures, separating duties, and having those multiple layers of oversight just to make sure that everything's being done properly and that no single person has too much control.
It's like that whole checks and balances system we have in government.
Exactly. And beyond those internal controls, there's also a big focus on business continuity planning. What if there's a natural disaster? What if the power goes out? What if a major supplier goes bankrupt? It's all about having backup systems and contingency plans in place to keep the business running, even when things go wrong.
So it's about being ready for anything.
Right. And then you can't forget about cybersecurity. These days, with everything being digital, data breaches and cyber attacks are a huge operational risk. Institutions are spending tons of money on cybersecurity to protect their systems and all their data from those bad actors.
It's like building a digital fortress around your assets.
That's a great way to put it. And what about liquidity risk? How do they manage that?
Well, it seems like having enough liquid assets would be key, wouldn't it? Having enough cash on hand to cover those short-term obligations, just in case there's a sudden rush of withdrawals.
You're absolutely right. Having that healthy cash cushion is essential. But it's also about diversifying your funding sources. You don't want to rely on just one. If that source dries up, you could be in big trouble.
So spread the risk again, right? Just like we talked about with investments and lending.
Exactly. You see that theme popping up everywhere in risk management. In stress testing, that's crucial for liquidity risk too. Can you handle a huge wave of withdrawals all at once? Could you get emergency funding if you need it?
Yeah.
You got to run those scenarios and make sure you got the resources to weather that kind of liquidity crunch.
It sounds like a lot to manage.
It really is.
Yeah.
And we haven't even gotten into things like regulatory risk and reputational risk, which are also really important. But let's circle back to something you mentioned earlier, economic capital. Can you explain that in a little more detail? It seems like a pretty important piece of the puzzle.
Yeah, absolutely. Economic capital is basically an institution's own internal estimate of how much capital it needs to cover potential losses from all the risks it's taking. It's separate from regulatory capital, which is that minimum capital requirement set by regulators. So it's like a buffer, a cushion to absorb those unexpected hits.
Exactly. It's how institutions figure out their own risk appetite and make sure they have enough capital to withstand those potential shocks.
And that ties into the concept of ROC, right? Risk-adjusted return on capital.
Yes, precisely. RAROC is a metric that lets institutions evaluate how profitable different business units are compared to the economic capital allocated to each unit.
So it's not just about making as much money as possible, but about making money relative to the risk you're taking.
You got it. It's all about finding that sweet spot where you're making good returns without taking on too much risk. It's about balance.
Okay, I'm starting to see how all these pieces fit together. It's like a big, complex ecosystem where everything is interconnected. Now, what about enterprise risk management, or ERM? This seems to be a more holistic approach to managing risk, right?
You're right. ERM takes a much broader perspective. It looks at all the different types of risk across the entire organization.
So it's not just about managing each risk in isolation, but understanding how they all interact and affect the institution as a whole.
Exactly. It recognizes that risks are all interconnected. A problem in one area can easily spill over and cause problems in other areas. ERM tries to break down those silos and create a more integrated approach to managing risk.
So it's about having that bird's eye view of the whole risk landscape, seeing the big picture.
Right. And it involves figuring out what the risk appetite is for the whole organization. How much risk are we willing to take on to achieve our goals? What are our absolute limits, those risks we won't tolerate under any circumstances?
So setting those boundaries for risk-taking, making sure everyone's on the same page, not straying too far from the plan.
Exactly. And it's also about building a strong risk culture within the organization. It means making people aware of the risks, encouraging open communication about potential issues, and making sure people feel comfortable challenging assumptions and speaking up if something doesn't seem right.
Because that culture of complacency or fear can be really dangerous, right? If people are afraid to raise concerns or question things, that's when those risks can grow and spiral out of control. It makes me think of that example Hull uses in the book about bankers' trust.
Oh yeah, bankers' trust. Their whole culture was about being aggressive, focusing on those short-term profits and complex derivatives. It ultimately led to their downfall. They lost the trust of their clients and ended up being bought out by Deutsche Bank. A classic cautionary tale.
So having a healthy risk culture is essential. It's about striking that balance between risk and reward, right? You want to make money, but not at the risk of putting the whole institution in jeopardy. We've covered a lot of ground here. From hedging with derivatives to stress testing for liquidity, it's clear that these financial institutions have their work cut out for them when it comes to managing risk. But even with all these tools and techniques, things can still go wrong, can't they?
You're absolutely right. Risk management isn't perfect. There will always be those unexpected events, those unforeseen consequences, and, human error. Those can all lead to losses.
So what's the takeaway here? What should we, the listeners, be thinking about as we learn more about this world of risk management and financial institutions?
I think the biggest takeaway is that risk is simply part of anything you do in finance. You can't eliminate it completely. The goal is to understand the different types of risk, to be able to assess their potential impact, and come up with strategies to try to mitigate them.
It's about making informed decisions, weighing those potential rewards against the risks, and always being prepared for the unexpected. It feels like we've just scratched the surface here, you know? This whole world of risk management is so intricate. There's so much more we could dive into. But I think one thing's for sure, risk is just an inherent part of the financial world.
Oh, absolutely. And one of the most important things about risk management, something we haven't really talked about in detail, is the human element. Because at the end of the day, it's people making those decisions, and people, well, we're prone to biases that can really affect those decisions.
Yeah, this is where things get even more interesting. We've talked about all these models and fancy techniques, but how do our own brains, how do they sometimes trip us up when it comes to risk?
Well, we can be influenced by all sorts of cognitive biases. These biases distort how we perceive risk and can lead us to make some pretty irrational decisions. Take overconfidence bias, for example. It can make us overestimate our abilities and underestimate the chances of something bad happening.
So we think we're better at judging risk than we actually are.
Exactly. We might take on more risk than we should because we're too confident that we can control what happens. And that can be really dangerous in financial markets, where things can change so quickly.
What about confirmation bias? I hear that one a lot these days. How does that fit into risk management?
Confirmation bias is that tendency to look for information that supports what we already believe and ignore evidence that contradicts it. You see this all the time with investing. People might hold on to an investment that's losing money because they've convinced themselves it's going to bounce back.
So we're basically just reinforcing our own biases instead of really looking at the situation objectively.
Exactly. And then you have anchoring bias, where we give too much weight to that first piece of information we get, even if it's irrelevant or outdated. It can lead to making decisions based on bad information.
So we get fixated on that initial number, like the opening price of a stock or some expert's prediction, and we can't seem to adjust our thinking, even when new information comes along.
You got it. All of these biases can affect how we make decisions about risk. They can create blind spots and potentially increase the chances of losing money. It's like having a blind spot in your car's rearview mirror. You might think you can see everything, but you could be missing something crucial.
So how do we overcome these biases? Is it even possible to rewire our brains to think more rationally about risk?
Well, the first step is simply awareness. Just knowing that these biases exist can help us be more cautious and question those assumptions we're making. It's also important to seek out different perspectives, to challenge our own beliefs.
So don't just surround yourself with people who agree with you all the time. Get input from people who might see things differently.
Exactly. And when you're talking about risk management in organizations, it's really important to build in those checks and balances. Don't just rely on one person's judgment. Get multiple people involved in making those big decisions to help mitigate the impact of those individual biases.
So it's about having a more robust system that takes that human factor into account, those inherent flaws in how we think.
You got it. Risk management is as much about understanding human behavior as it is about those numbers and models.
Well, I think this has been a really eye-opening deep dive into risk management in financial institutions. We've learned about the key players, the different types of risks they face, the strategies they use to try to mitigate those risks, and how important it is to recognize those human biases that can really cloud our judgment.
Yeah, we've explored that delicate balance between risk and return, the complexities of model risk, and the need for that more holistic approach, that enterprise risk management. It's a really fascinating area, and it's always changing as new risks pop up and new ways to manage those risks are developed.
It's clear that there's no easy fix, no one-size-fits-all solution to managing risk. It takes a multi-pronged approach, a combination of quantitative analysis, qualitative judgment, and a deep understanding of how people behave.
Absolutely. And as you keep learning about all this, just remember that human element. Challenge your own assumptions, get different viewpoints, and remember that in this world of risk, a healthy dose of skepticism can be a good thing.
That's some great advice. Thanks for joining us on this deep dive. We hope you found it insightful. And remember, risk is everywhere. But with the right knowledge and a clear head, you can navigate it effectively.
Until next time, keep learning and stay curious.